Again, hello everyone. Welcome to this afternoon webinar. My name is Theo, for those who don't know me yet, and I'm here to present you Mr. Paul Wallace. So just very quickly, make sure you download the podcast and keep on update your knowledge with the relevant fundamental market information. So it's going to help you a lot in your trading. I shared the link with you here on the chat box. Also, let me share the screen. Also, the YouTube channel, I shared the link of the global YouTube, Admirals Global YouTube here at the spotlight. You can find all Paul's recording webinars, an excellent area that you can get education. And I would highly suggest you to go and watch, if you haven't, the previous webinars Paul made. We have also the Telegram channel, this one here, and you can find information about everything what's going on in the markets, in the stock market, and also the Instagram. Please make sure you follow us here. We put reels, we put market updates. Both Instagram and Telegram, you can use it in your advantage, and of course YouTube channel. Paul, hello, welcome.
Good afternoon, Theo. Nice to see you.
It's pleasure. How are you doing? Good.
Not too bad, thank you. Not too bad.
That's
and yourself?
Nice. I'm very good, thank you. So I will leave you to take on. Yep.
Absolutely. No, thank you. Thank you for that. Thank you for the introduction, Theo. Hello, everybody. Hello, everybody. Great to see you here this afternoon for our session here. The next kind of session in, let's call it like Paul's Ultimate Price Action Trading Guide here. Great to have you here with us today. And today we are going to be talking about a particular favorite little setup of mine, namely the key day reversal. So as always, if you know you're joining us here live, you can ask away your questions. If you're watching this later on demand, you can put them into the comments box. Make sure you are following us on the Admirals YouTube channel. As always, I recognize that we have a broad range of experience of people who join us for my sessions, from complete beginners to experienced traders. You're all very welcome. We're going to be, focusing and helping people, give them new traders, give them insight into how to utilize price action session by session, building up into an overall trading plan for us. But also for those intermediate and experienced traders here, there'll be a couple of little nuggets in there that you can utilize and take away in your own trading. And also recognize here from our Admirals that, this is the English speaking webinars have a truly global audience. So for wherever you are joining us from in the world, you're very welcome. We hope you're well, and we hope you're doing well in these rather eventful and volatile times we find ourselves this year. So without further ado, why don't I bring up the slides and let's crack on with basically having a chat about a key day reversal setup. So just bear with us one moment here, ladies and gentlemen. Let's just get this up and working for us. Let's just bring up my charts and slides here, okay? And as always, we'll look at live markets as we go on into the session, so be sure to stay with us to the very end. So session 6, trading the key reversal. All right, key reversal, you might hear me call it a key day reversal, which I'll explain more, but it is a simple setup which I like, and I will explain during the session why I like it. And in terms of absolute price action, it's a great little setup to utilize and know within your own particular trading setups. So remember, here we are, Admirals, okay, a global broker with local support, licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and allowing you to engage with markets using both MT4, MT5, and also the Admirals Supreme Edition. Any questions about Admirals, get in touch with your account representative and they'll be very happy to help guide you. So what are we going to talk about today? Well, not unsurprisingly, we're going to talk a little bit about price action trading. If this is your first session joining us, as I said, you're very welcome. But I'm going to talk about what is a key day reversal. All right, what is that? Okay. Where do we find them on charts? How can they help us? And how do you trade them? And then, as I said, we'll look at them in live markets. We actually had a few set up over the last couple of days. All right, so it's well timed, okay, that we can actually talk through this in an educational environment and then actually look at how they are setting up and how they're playing out in live markets. I know that always helps a trader just get a little bit of a better, better grasp on the concepts we share, and invariably the, how they do, how they play out once you can actually see them in live markets. As always, I recognize that, we're doing particular elements and price action trading and a particular setup. But as I always say, whilst we're looking at specific instruments and specific timeframes, all of the concepts, setups, tactics, and stuff that I share with you, I'm always very keen for them to be, you'll hear me say it constantly, about how they are timeframe and instrument agnostic. So you can use them on any timeframe and on any particular instrument. They will have particular timeframes and instruments that they work better on, but as a general rule, you'll find these setups, they show up across everything. So I don't care whether you're a monthly trader on gold or a 5-minute trader on Bitcoin, whatever. You will find they will find that across all instruments and all timeframes, key reversals set up. Okay, and I'm going to talk you through those here today. For those of you who don't know me still, my name is Paul. I've traded for many years. Okay, traded for funds and for clients. Okay. Primarily, I like to focus on FX and commodities. They're my preferred instrument classes. For my longer term trading, I tend to be a trend trader preferably. And for my shorter term trader intraday, that's when I'll be a sort of kind of a reversal trader looking for mean reversion. That's the way I work and operate. And I'll be sharing some of my experiences as we go through this particular session. So here we go. This whole webinar series about Paul's ultimate price action guide, all right? And as it says, we're going to continue this series today based on helping traders understand and also utilize price action in their trading. As always, it would be kind of useful to know, those of you joining us here today in the room, how many of you actually have experience of trading with price action? How many of you, it's a completely new concept? How many of you know what has been your particular experience? Maybe just put a couple of comments in the chat box. That would be great. Let me know what you're particularly thinking or saying about it, so that I can actually help you as much as I can. Good afternoon to you, Raquel, as well. Nice to see you here with us. As its slide says, that it's kind of easy for beginner traders to be intimidated by the amount of knowledge required to be able to analyze markets. However, with a bit of education from these sessions and a little bit of understanding about candlestick and price action and how they tell what they tell us, then it becomes easier to analyze and understand markets. So each Wednesday, what we're going to be doing is building upon the previous sessions that you're educated and informed how to use price action in your trading. We want to build this up over time into, a really good, solid sort of, price action trading plan. Patient says, good afternoon. I know a little bit about price action. Okay, well, that's great. I appreciate your input there, Patience. Hopefully by the end of these sessions, you will know an awful lot more about price action. That's the whole aim of the game. So as I said there, very often I find new traders overcomplicate it. Okay, the charts are just filled with dozens and dozens of indicators. All right, okay, all trying to help them, give them what they might believe is a bit of an edge. And actually, very often, it's less is more. Human beings, and I've said this before, human beings, and men in particular, we tend to overcomplicate things, and I have been guilty of that as much as the next person. All right, and actually, what we've realised is that with a bit of time and a bit of experience and a bit of confidence, self-belief, you realise that actually sometimes less is more, and that actually you want to strip stuff away from your charts, keeping them simple, and actually with a good understanding of price action, you're in a position to make good trading decisions yourself. So Peter says, price action is the basis of my trading, really starting to get around using higher timeframes for direction and faster timeframes for the trade. That's fantastic, Peter. That's great. Thank you for joining us here. Thank you for giving us your thoughts and insight. That's always appreciated, really good, and it helps me, but also helps everybody else just to get an understanding of everybody else is trying to understand. Raquel says, trying to understand it, mainly when to exit. That's a very good point. Okay, that's an excellent point, Raquel. Thank you for that. And you know what? What we'll do is we will do a future session just on exits. All right. Everybody likes to talk about entries. Everybody likes to talk about setups. But what we will do is we'll actually do a session just on exits, just on how to find good exits. Okay, for your trading. So thank you for that. I'll take that on board. All right, and we will build that into this particular series. So for those of you who are joining us for the first time, those of you who are new to trading, what is price action trading? It's really a basic means of market analysis using price movement over time. It is both popular and used by both retail and institutional traders. And what we're doing, we're analyzing the change in prices over time. And that is what the action is. We will be typically focusing on price action over the last 3 to 6 months, all right, because we'll be looking at we're using, let's say, the daily chart as our sort of our datum, so to speak, but also respecting longer term price movements. As I said, price action trading and also the, as I said, the kind of tactics, set of concepts that I share with you can be used across all time frames and all instruments. But in order just to give us a little bit of focus during our sessions, as I said, I'll be focusing mainly on the daily chart as our, let's say, our datum, but I will also be showing lots of examples up and down the time frames so that you can get an understanding that, these ideas and concepts work across the whole thing. I also recognize that a lot of the people joining us or watching this video later, they're probably part-time traders trading around, a day job, or maybe have lifestyle commitments. And so actually, you're not there all day, every day. You might be doing just a short bit of trading on the daily chart. And so, that's where we're going to focus on. But as I said, they work across all time frames and instruments, all right? And then it's just a little bit of practice will get you the opportunity to sort of see these setups and see how it works in price action. So, what have we learned previously so far? Session 1 was, not unsurprisingly, just an introduction to price action trading. Session 2, we looked at the engulfing candle, okay? Doesn't happen very often, but it's very useful to know when it actually occurs. We talked about how identifying a trend and how you'll hear me always say, good trends leap off the charts. You don't force it, okay? Don't force it. Session 4, we talked about the star formation, the morning star and the evening star formation. Another very simple setup that will work across all time frames and all instruments. And last session, we looked about preparing for opportunity markets. It was about actually, getting yourself ready to trade, okay? Putting yourself in the best place possible so that you can actually make better trading choices during your trading session. And today, well, we're going to talk about trading the key reversal. Like the engulfing candle session, like the star formation candle, simple price action based setups that you can take on board, you can build into your own trading and utilize going forward. Okay, excellent. So, and as also I should say, all of those videos are on the Admirals YouTube channel, okay, which what Theo sort of introduced us with. So if you've not seen them, or you need a little bit of a reminder, go back to there, okay, have a look on there. You'll find all those videos in there. If you want to understand the setups better, you can go and watch them again. You can rewatch them, practice, okay. All of that will help you within your own trading, ladies and gentlemen. So, trading key day reversals. You'll probably hear me label it as KDR, key day reversals, okay? So, lots of people have heard about trading key day reversals, but may not actually be aware of what that actually means. It's just a simple price action setup that allows us to identify the possible end of a trend and position ourselves for what might be a new trend. It's a simple trading tactic to use, all right? But what I find is, as I've said, is many people are either taught the wrong way or they overcomplicate the use of them, all right? And today what I'm going to do is I'm just going to explain and share some simple ideas how to trade markets using key day reversals. You'll hear me talk about either key reversals or key day reversals. The reason that people would sometimes call it key day reversals is because a lot of the trading was done on daily charts, okay, and that's what they're looking for because they felt that it had its most potency as a setup on the day chart. But as I will show you, you will see that these key reversals, they set up everywhere, and it is the specific elements of how it sets up that becomes important, all right, which I will explain in the next couple of slides. So bear with us and we'll explain to you. So the good thing about KDRs, key day reversals, is that they're ideal for daily, weekly, monthly charts, but also across all timeframes. It is a simple reversal tactic, best used to identify low risk, high reward opportunities, which is what we actually particularly want. After a concerted move in one direction, we're looking for momentum to reverse. As always, we're more interested when it happens at key levels, when we get confluence of events. And when that happens, well, if there's a specific setup that we can utilize to help us provide an entry. So the thing I said at the start, and I repeat all the time, candlesticks, are very useful, very effective, indicators in their own right. Then, they're the simplest form of price action, you might say, in terms of price action trading. But what you have to remember is that candlesticks, by their very nature, are a reversal pattern. Okay, they are a reversal pattern. So what's important is that actually they have something to reverse. That's the key thing, all right? That's something that it has to be something to reverse. There has to be a little bit of a trend in place. Sometimes that trend might be days, weeks, months long. Other times it might only be a couple of sessions long, okay? But there has to be something for it to reverse. And sometimes people forget that, okay? Or they get excited when they see either a pinball or something and they just want to jump in and get the trade on. And I'm here to say they'll actually just think, just take a moment to think, all right? And when you see price like here going sideways, okay, price is going sideways there in a congestion range, you know, candlesticks aren't really helping you massively, right? They aren't helping you massively. They're helping you when you've had a good move in one direction, and then you get a KDR, it gives you an indication that, you know, the momentum is changing and actually price is likely to go in the other direction, all right? So just take that on board. Just remember that. Don't forget that, you know, candlesticks are great, but they're a reversal pattern by their nature, so they have to have something to reverse. Trading them in a range of consolidation or looking for them, you know, it's not as potent, it's not as effective. So just a little bit of, like, let's say a little bit of a hard-earned nugget of experience that I can share with you that, you know, you can utilize in your own thing. So as I said, if you've got a comment or a question, you can put that into the chat box. You should have access to it there, okay? And I'll try and do what I can to help you answer those as we go through. Now, there is no perfection in trading. You've probably heard me say, and key day reversal, which I'm about to explain to you, they are very simple, very useful. But the challenge we have is that they happen rarely. They don't happen as often as we would like, right? And you have to sort of, you know, work with that. You have to understand that. But what they can do is they can signal the end of a trend. The higher the time frame, the more validity they have. But I would say that for pretty much all candlesticks. And what it will help is provide clear proof that the previous trend is either over or it is very close to its end, which I'm going to show you in a few examples as it is. So just so you remember, there is no perfection in trading, okay? There are pros and cons to every setup, all right? Key day reversals, I like them a lot, but they never happen as often as you would like them to occur, okay? That's the thing you have to take away. So you have to be a little bit patient, but it is easy to be patient if you know exactly what you're looking for, all right? And that's what you will do by the end of this session. So what is a key day reversal? As it says, it's a sharp reversal pattern that occurs during a trend as it's coming to an end. In an uptrend, price open at or above the previous day's close, it makes a new high, and then reverses and closes below the previous day's low. And that's the important thing, okay? That's the important thing, all right, which we'll talk about. The greater the price range of volume on the key reversal day, the more reliable the signal. So what am I talking about here? Well, you know, you can see here, I mean, there's an old chart here, but, you know, it doesn't really matter. The price has been in an uptrend, hasn't it? Remember what I said? We need to have something to reverse. And if you look at this, black candle here, okay, where the arrow is, what we can see is that the previous, this is a weekly chart, the previous week closed here. We opened the same price, okay, and normally what happens, you know, you'll see these days in electronic markets and FX. At some point during that week, price pushed to a new high, and that's the important thing. It pushed higher than the previous week's high. It pushed higher, went to a new high, okay? However, what happened was, we can see, I'm just going to clear this down to help us, price reversed and it fell all the way down. And the important thing is it closed lower than the previous candle's close. So we pushed to a new high, but closed lower than the previous candle's low. It's closed lower, not traded lower, actually closed lower. And not unsurprisingly, here we go, you know, that is a very bearish looking candle, as it is. And what we saw was actually the price over the next few sessions drifted down. As I said, they don't happen as often, all right? They don't happen as often as we would like, but when they do happen, they can be very, very powerful. So the important thing to remember is that the price in that candle, in an uptrend, price pushes to a new high. Okay, it's important to push to a new high, but then price reverses, falls, and closes lower than the previous session's close. Well, that may be a week, might be a day, might be a 1 minute chart, whatever. All right, that's the important thing. And I want you to think about the psychology of what's occurred there. This has been in a very clear and strong uptrend, hasn't it, ladies and gentlemen? But for some reason, you know, there could be a multitude of reasons. that the bears, the sellers have stepped in and they have wrestled control of that market. They have wrestled control of that market. They have taken the control from the bulls. And so we are expecting the higher probability in terms of the direction of movement is likely to be to the downside, to the bear side. And we are then in a position to position ourselves to take a trade in line with that. And that's why they start to become very, very useful. They start to become very, very useful to us. So Teresa said, is the KDR used in all timeframes? Absolutely, Teresa. You can use it across all timeframes and all instruments. I'm going to focus on more of the kind of the higher end timeframes for this session, because I appreciate lots of people are trading higher end timeframes around their, let's say, their day job, but you will find KDR set up across all timeframes, all instruments. And as I was just explaining there, you just have to realize they have validity when you see them happening at the end of a trend, or at the end of a move. Okay, and that's a weekly move. So realistically, that was going on for months, wasn't it? But actually, that could be a couple of candles, so long as there is something to reverse. That's what we need to understand. So I hope that helps answer your question there, Teresa. Thanks for the question. And in this particular case, is kind of another example. All right, okay, it's on the flip side of it. Okay, for a bullish key reversal, it's a reversal pattern that occurs at the end of a downtrend, where price opens at or the same price as the previous day's close, makes a new low. Remember, that's the important thing. Then reverses and then closes above the previous day's high. All right, that's the important thing. In this particular case here, what we've had is, price had been in a downtrend, it moved away. Price came down here, clearly a downtrend there, isn't it? But then look what happened here. Okay, the previous session candle closed, right? I think this was a daily chart here, if I remember right, is the previous candle closed. Next session opened. Here's the important thing, remember, it pushed to a new high, which was also just so happened to be a support level, pushed to a new low, my apologies, pushed to a new low, and then price reversed, rocketed all the way up and closed, and it closed higher than the high of the previous candle. And in fact, in this case, it closed higher than your 3 candles, all right? And that was a bullish key reversal. After a downtrend, price in that session pushes to a new low, but reverses all the way up, closes above the high of the previous candle. Now what you can see is, price went sideways for a bit before it started to take off there. Okay, this, happening, there's a confluence of events, there's a bullish key reversal at the end of a downtrend at a level of support, confluence of events, bosh, we have a trade set up. Okay, as I said, they don't happen very often, but when they do, most definite worth sitting up and taking notice of it. So what you will find is that a key day reversal can form in many ways. However, many times a key day reversal, it might also look like a pin bar. It'll be an engulfing candle. It can be a combination of both. Okay, just remember. In this particular case here, what was this? This is silver, all right, commodity in the daily chart. See, price actually sort of drops all its way down there. Price pushes to a new low, but closes higher than the previous candle's close before it rallies up. Goes all the way up. What starts to tell us that this trend is over? Well, this candle here, okay, price pushes to a new high in that session, but closes beneath the low of that candle. And what happens is price goes down and then actually rallies up again. And that's what I said, there's no perfection, but as I said, a key day reversal can tell you the end of a trend or that the end of a trend is close, because what happens is that pushes up for another couple of days, but then what does it do? It sets up another key day reversal. Price pushes to a new high there on this candle, but then closes beneath the low of the previous candle. The bears have finally taken control of the market, and bosh, you can see what actually occurred there. All right, so as I said, they don't happen as often as we'd like, but when they do take up, they're indicating that the trend is either over or it is coming close to the end, like that particular example there. And they will find them on both the kind of bullish key reversals at the end of a downtrend, bearish key reversals at the end of an uptrend. Okay, that's what we're particularly interested. So an example here on the S&P 500, the key day reversal. Okay, price has been in a very strong uptrend. Okay, it formed a little bit of a level of resistance, and then what we had here was price pushed to a new high. Price pushed to a new high, but it fell down, collapsed, and it closed. Okay, it closed beneath the low of the previous candle. Doesn't have to be by any amount, it could be by 1 pip, 1 tick, etc. Okay, the important thing is it is closed beneath the low of the previous candle. Now, what we also have with that, what kind of pleases me with that is that candle there, which was, it's a key day reversal. It's also the pin bar, isn't it? Also an engulfing candle. It's also a false breakout as well. So once again, we've got a confluence of events. We've got 2, 3, 4 things coming together at one time and place that gives an indication that this trend is over. And what actually we saw was that, a couple of days later, Bosch price actually just collapsed, okay, and continued actually zigzagged and continued to collapse its way down there as well. So, as I said, they don't happen as often as we'd like, but when they do, all right, when you see them on higher time frames as well, take note of them, okay? Because one thing you can utilize, and maybe for even for let's say the intermediate or advanced traders, is if you're a trend trader, and you've been long in this S&P here, well, when you see a KDR against you, that's if you're not already out of the trade, that's probably a little bit of a heads up that what, this trend is probably coming to an end. I might want to just start to tighten up my stops. I might want to start to just see, just watch this like a hawk, because what might happen is Bosch, it might reverse very quickly against me, okay, and give back some of the generated profits from my trade. So, as I said, for the intermediate and advanced traders, if you're trading trends, okay, when you get KDR trades against you, prints against you, that's just a little heads up that you could utilize for your own ideas and trading, ladies and gentlemen. So, here's an example of silver KDR. This was a lovely trade. And there you go, even if I say so myself. Price has been in an uptrend. Daily chart price actually puts in a very nice, that's a bull flag, okay? Bull flag ended with a pin bar. Price rallies up to the 200 period moving average, okay? You'll see on my charts, even though most of these price action, I'll also have the blue 20, the red 50, the green 200 period moving average on my charts to help me. And then what do we print here? Okay, what do we print here on the silver chart? Price pushes to a new high. Okay, it's clearly pinned against the 200, but price pushes to a new high during that session, but it just rolls over, collapses, and falls away and closes beneath the low of the previous session's candle. So that is a bearish key day reversal. Also happens to be an engulfing candle. Also happens to be a pin bar as well, a rejection candle. What happens is the next day it tries to push up again, it can't, and Bosch, off we drop there. Okay, and we get a significant drop. And that's what I want you to be able to recognize, okay? Happens at the end of trends, okay? When we see it at the end of trends, we want to be able to trade that. It's a very simple setup. And one of the reasons I like it is that there is no ambiguity. It is very clear. And, for a bearish key reversal, price has to be in a trend, has to have moved up, price has to push to a new high, and then it rolls over and collapses, and it has to close beneath the low of the previous candle. So there's no ambiguity. It's very crystal clear. And I think for new traders, that can actually help them, because it is either a key day reversal or it is not. If it is not, ignore it. You don't need to do anything. If it is, this is a trade setup. Okay, that's one of the reasons I like it. I like very simple, very clear trade setups, okay, where there is no ambiguity, where there is precision almost, okay, in terms of what has had to occur in the market to give me that setup. And that helps me, all right, rather than just being a bit flaky and a bit ambiguous and just thinking, oh, it's going up, I'm going to buy it. That's all nonsense, okay? What you want is just simple, precise setups that you can utilize and see and learn off by heart and utilize them in your trading across all time frames and all instruments. So I've got quite a few examples here, okay, not unsurprisingly, because I think more examples, different instruments, different timeframes give you an idea that you can see how how markets react and operate. This was Aussie dollar on the 4-hour chart. Price had rallied up a bit. It puts in one kind of key reversal there before it drops down. And what ends it? Well, what's this candle here? Price is pushed to a new low after a downtrend, but then it closes above the high of the previous candle. That is a key day reversal, okay? Price rallies its way up, a nice bull flag, pulls away again. But what ends that trend? Well, what happens here? This candle pushes to a new high, rolls over, completely falls away and collapses, and closes beneath the low of the previous candle. That is a bearish key reversal. And what we can see is price comes back to the 50 and actually goes even much further, doesn't it? What gives us a signifier at the end of that trend? Well, the price comes down here. What does it do? Price pushes, and this 4-hour candle price pushes to a new low, but actually rallies all the way up massively and closes higher than the high of the previous candle, and in fact the next one as well. And that ends it before price rallies up there. So there's a nice 4-hour chart. That's over what, 3.5, nearly 4 weeks. But there's 3 trades there. There's kind of like 3 trades there at least. Okay, just trading key reversals on 4-hour charts. Okay, and without too much stress, all right, without too much pressure on you. Okay, as I said, they don't happen as often as we would like. So when they do happen, sit up, take note. Okay, have a look at them. Just it's a simple way. All right, it's a very simple way to trade swings. Okay, I think it's a really really nice, simple way. Dollar against US dollar against Canadian dollar. I wanted to put up like a scruffy chart because markets aren't always pretty and simple. They can be scruffy. Price here, okay, has been working its way up in a bit of a channel there, but what happens with the under in the channel, namely the price here in this candle here, price pushes to a new high. Right, when it pushes to a new high, rolls over, closes beneath the low of the previous candle, closes beneath the low. That is a key day reversal, and what happens? Bosh. And even if you're looking to take that part of move, that is still a very good reward to risk, regardless of whether you try to sort of run it all the way down as far as possible. And that's what we're looking at here. On swings, it gives you an opportunity to get a good simple setup with also a nice reward to risk. And this is, I remember this very well. This is very big weekly chart, okay, of the pound against the US dollar. Price had been in a downtrend. What happened here? Price pushed to a new low, rallied up, closed higher than the previous candle's high. That is a bullish key reversal. Price comes up and it falls back a little bit. There's not a real shock, but then what does it do? It prints another, okay, bullish key reversal, a weekly chart. Pushes to a new low, rallies up, closes higher than the high of the previous candle. And then what happens is we get about a year or so of price rallying up until it puts in a double top here. But what ends that double top? Price in that week pushes to a new high, but folds over, collapses, closes on its lows, closes, most importantly, beneath the low of that previous candle. And then price dropped down there for a few months. And that was actually the high for about a couple of years. So as I said, you've had 3 of them there in a period of like 12 months. As I said, they don't happen very often. But when they do, you want to sit up and take notice of them, ladies and gentlemen. Teresa asks, how would political and economic news affect KDRs? That's actually a really good question. Very often they may be the thing that creates, all right, the KDR, because sometimes price will have been rallied up into a particular level, or it will be rallying up into maybe a particular news element, or whether that be a formal news element, maybe like NFP, CPI numbers, etc., or maybe just an unexpected piece of news like like the Russian invasion of Ukraine, etc. Some savvy traders expected that. Most people did not. And that can change the price action so that actually, that is what creates the key reversal. And that is a very good question, Teresa, okay? And so, if you had news that leads into creating a key reversal, that should just give you more confidence that, gosh, I have a confluence of events. There's 2, 3, 4 things all coming together at one time and place. That's my trade signal. Great question, Teresa. Thank you for that. I hope that helps you. Lots of more examples. Okay, here and once again, pound against the US dollar on the weekly chart. Get rid of all those drawings. And as I said, remember, we want these to finish a trend. There has to be a trend to end. It runs in here to the 200 period moving average. What do we have here? Price opens, it rallies to a new high, completely reverts, collapses and closes, all right, beneath the low of the previous candle. And what does it do? Bosh, it goes all the way down, all right, all the way down there. So, and that was what, 6 months, 6 to 9 months trend there. Okay, so as I said, doesn't always happen often, but when it does, you want to take notice. Okay, and remember what I was saying. KDR, it is either there or it's not. Okay, it has to push to a new high, has to close for a bearish from beneath the low of the previous candle's close. So it's there, it's either there or it's not. And I think for new traders that can be very helpful because it allows the opportunity for a new trader to recognize there's some precision there. Okay, either the setup is there or it is not. For our examples on the cable, you can tell that I'm a sterling trader, can't you? Okay, Once again, price in a nice uptrend. What ends the uptrend? It's this candle here, opens, pushes to a new high, rolls over, collapses, closes beneath the low of the previous candle, and there, we move all the way down. We move all the way down until what? Well, we've been trailing down here. This candle here, price pushes to a new low, doesn't it? Then it rallies strongly and basically closes above the high of that previous candle. And then what happens? Bosh, off we go. Okay, so that's what we're looking for. That's 4-hour charts. There's a lot of trading. Just even trading FX on 4-hour charts using key reversals, that can be a very, very simple way. Very simple way for a new trader to operate. So with that in mind, how do we trade them? Well, ideally, what I suggest for new traders is ideally, if you can find them providing a re-entry to an existing trend, that is lovely. The reality is, though, is that most key reversals will print as a simple reversal pattern at the end of a trend or very close to the end of a trend. So how do we trade it? Well, here we go. We trade it. Firstly, once we've identified one, we trade an entry on the break of the candle in the direction of the close. So in here, what we'll be looking to do is to have an order beneath the low of the KDR. Our stop loss would always go on the other side of the candle. So if that was on a daily chart, I'd be looking for basically for a bearish candle. I'd be looking for my short entry to be in for about 2 to 5 pips beneath the low of the candle. My stop between 5 to 10 pips above the high of that candle. Okay, the stop loss there. That's it. And then what I normally say is to begin with, okay, even if you can just generate a 1.5 to 1 reward to risk, for new traders, that actually is very useful. But what I suggest is as you get a few wins under your belt and a little bit of confidence, well, then maybe you might want to extend your reward to risk, start looking at 2 to 1, 3 to 1, 4 to 1, etc., based upon your own risk profile. But as I said, if to begin with, if you've got, asymmetric reward to risk of 1.5, okay, 1.5 times your trade risk, okay, in terms of your profit potential, that's a good starting place. And as I said, for intermediate traders, existing trend traders, if you're already in an existing trend trade and a KDR prints against you, well, then get ready for your trade to end, all right? It's a good signal that, that trend is coming to an end and you might want to just get ready to leave your existing trend trade. So that's just a little nugget of experience that I'm sharing with you there. So, the question is, based upon what you've seen there so far, do you believe you could trade these? Okay, do you think that it's a simple setup that you could take on board and utilize? It's just the price action giving you an indication that that trend is over. It's giving you a very, very clear, all right, setup. Okay, and you're looking to trade there. Think about based on what you've seen here, is that something that can fit with your own particular trading style? Is it something that is a simple setup that you could utilize yourself? So here you go. Here, before we switch across to the live charts, your task from today's session: go away and look through your favorite trading instruments and try and identify, were there possible key day reversals there? How did the market react after they were printed? How far did the market move in the new direction? And was that a possible trade for you? Was that a good trade for you? Okay, have a little look at that. Raquel says yes, that's great. That's what we want. I'm doing my job here, helping to educate you, giving you new ideas and concepts to take away that you can utilize in your own trading as well. So in conclusion, let's just before we switch to the charts, key day reversals, they're a rare but powerful setup. They're setups where the market has been overwhelmed by the opposition. Okay, they've stepped in and taken control of the market, demonstrates total psychological overwhelm by the opposition. That is what provides us with the basis of a simple trading plan. With that in mind, why don't we go and have a little look at the live markets and see a couple that have maybe been setting up in the last day or two. Before then, just remember, join us next Wednesday for the next session of Paul's Ultimate Price Action Guide. What we're going to talk about next week is about managing risk, all right, including what is risk management, how does a trader manage risk, why is it so important, okay? I always pass on to new traders that, if you are not managing risk, your trading career will be probably much shorter than you would hoped. Managing risk is your first and foremost priority. So be sure to join us next Wednesday at 2 o'clock London time to just have a little talk about, managing risk. We'll talk about how we utilize that in regards to price action trading. As always, if you've got any questions, you can contact Admirals, okay, and the email there, Global Admiral Markets, as it says there. And as always, as I said, got the YouTube channel and the Facebook channel that you can follow, and you'll be able to see recordings of this video and the rest of the series there to sort of, to help educate you. So just bear with us a second. What we're going to do is I'm going to switch across to the Admirals charts. We've got about 5 minutes. We'll have a little look at the live charts, and we'll take a look and see what's been going on there. So just bear with us a moment, and we'll switch across. So just bear with me, ladies and gentlemen. Now then. Okay, bosh. So I'm hoping you can still see me, hoping you can still hear me, hoping you can see the Admirals platform here. This is this week today we've got MT4, but in other weeks we'll use MT5, and I'll show you the differences between them. This is a profile that I have set up here. Okay, let's just get the order on. This is a profile that I've just got for a US dollar. And I think I talked about in session 1 is that setting up little profiles on your MetaTrader platforms like this, where you can have 8 charts, okay, and set it up for a particular currency, maybe for equities, maybe for indices, etc. It's enormously helpful because you can very quickly identify what's going on there. So this is one I have just for the US dollar, because within an FX markets, I keep saying the dollar is the daddy, right? Okay, it's the big boy, it's the big gorilla, right? The big silverback gorilla. So you want to know what the dollar is doing if you're going to trade FX markets. Okay, you want to understand it, and you can do that utilizing the US dollar index chart. That's a good starting point. I have it down here. Let's bring it up. Bosh. I have not done it to update this a little bit better. This is the daily chart of the US dollar index. So it's giving you, it's the dollar against a basket of currencies, and it's giving you a quick insight into, whether the dollar is strong, whether the dollar's weak, whether the dollar's, on a tear, whether the dollar's going sideways, because that will have huge impacts on other currencies, all right, as it's the biggest main traded one. There you go. Peter saying, interesting. From about an hour ago, KDR on the FTSE 15-minute chart could have made around 2-to-1 over the app. Nice. We will have a little look at that, Peter. Okay, thank you for that. We'll try and bring that in, okay, and see what's happening. This is the daily chart, okay, of the dollar index, and gosh, it has been mostly in a very big, strong uptrend. It pulled back here. What did it give us here? Price falling down a bit. Price pushed to a new low, rallied to a new high, closed above the previous candle's high, before it actually rallied its way up. Rallied its way up to these recent highs, okay? And then what did it print here? Price basically opened there, pushed to a new high, rolled over and collapsed. And what did it do? It closed beneath the low of the previous candle. Bearish KDR, price falls. Price tries to rally again. Price tries to rally again. But what does it do here? Opens, pushes to a new high, but then falls away, closes beneath the low of that candle. Price starts to fall down, but it has to try again. It goes up a little bit. Price opens, price pushes to a new high, rolled over and collapses, closes beneath the low of the previous candle. And then what do we see is over the next few days, we've seen price just drop really quite significantly there. So, what we've got there is you've got 1, you've got 2, you've got 3 bearish KDRs there on the daily chart of the dollar index. Okay, that's telling you that that big trend is coming to an end, and that's what we've started to see. We start to see price just roll its way down there. Okay, and that's what starts to give us the indication that that market is changing. Okay, there is change afoot. So the thing about the dollar index is that because it's made up of about 57% of the euro, what we see is the euro is doing the exact opposite of the dollar index. So let's have a look at euro dollar. Euro dollar has been in a daily downtrend here, okay, in a very nice daily downtrend, right? Now, every time it came back up to the red 50, it bounced away. And every time it came up, bounced away. But what happened here? Price has fallen quite significantly, but then what does it do here? It opens, pushes to a new low, rallies all the way up, basically closes higher than the high of the previous candle. Bullish key reversal, price rallies up for the next few days. Price drops again, but what ends it is price opens here, pushes to a new low over the last few days, but rallies up strongly and closes above the high of the previous candle. That is KDR2. Price pushes up, falls back. What does it do here? Opens, pushes to a new low, rallies strongly, and basically closes above the high of the previous candle. KDR number 3. And what happens is price rallies up there. So the dollar index and the euro dollar, they're normally inversely correlated. So what we see on one, you see another. And in the same way we saw 3 bearish key reversals on the dollar index, you've seen 3 bullish key reversals on the euro dollar. There's something to sort of just take on board and look at. So what would be the best entry exit point? Well, what I was saying, Teresa, is personally to start with what I say is I would have a target that is 1.5 reward to risk. Okay, so whatever the difference is between your entry and stop loss and say the number of pips, let's say for the want of a simple example, it's 100 pips between your entry and stop loss. Well, then I'd want my target 150 pips, 1.5 times, my trade risk. Okay, that's to begin with. Just get a few trades under your belt, get a couple of wins under your belt, give you a little bit of confidence. But then with experience, well, then what you'll do is you'll see there's ways and means to basically sort of to find longer, better trade reward to risk for you. But good question there, excellent. So there's a couple of examples there. I think here we go. Yeah, we had a look on Kiwi dollar here. Okay, is that Kiwi dollar had been in a very nice downtrend. Okay, very nice downtrend, and here it prints a key reversal here. All right, but actually it fails us, and that's okay. Nothing is perfect, but remember what I said. If you're printing a key reversal against you, if you were short, when you see that, you realize it's probably time to exit your short because the trade is coming to an end. And what actually happens is, price does drift down a little bit, but then what does it do? Here, price pushes to a new low, rallies up, closes above the high of the previous candle. Key reversal there. Price starts to edge its way up. And then actually this day, on that day, price pushes to a new low, but closes above a new high. It's just giving us a bit of confirmation before prices continue to maneuver. So, as I said, that first key reversal didn't, if you'd have traded that, you'd have lost. Okay, you'd have bought in it. But remember what I was saying, that just because nothing's perfect, that failed, but keep an eye on it, because actually what happens is it's set up again. It was telling us that this downtrend was over. All right, it's over, and that's what we can see as occurred there. Let's just for quickly a moment. So let's see, can I bring up, have I got an indices one on here? Maybe I'll have a look at that FTSE if that's what Peter was saying there. Let's have a little look and stuff, see it can help. It's always, as I said, it's always good to have a little look at what's actually going on in the charts, isn't it? Seeing what's going on live. I think Pete said it was a 15-minute FTSE. Let's have a little look. Gosh, bring it up there. You're absolutely right there, Peter. Nice maneuver there. Okay, we can see price had moved down. Okay, and then invariably what we had is price pushes to a new low, but then it rallies strongly, closes above the high. That was a key reversal there. And what happens is, bosh, you can see, and a good target for that trade would have been 7,000. 7,000, big round number there. Okay, so the opportunity to, from our entry about what's that, about 69.75, 25 pips or 25 points on the FTSE. There you go. So I mean, that's a 15-minute chart on an index. As I said, they happen rarely, but when they do, it's worth you keeping an eye on there. So there you go, ladies and gentlemen. Unfortunately, time flies when you're having fun, and we've run out of time there. But what I'm hoping is that has given you an insight into the key day reversal setup, and I hope that's given you something you can take away. Start to go away and look at in your own particular charts, find out where they've occurred, okay, on your charts, on your timeframes, your instruments that you like, and see, how did they play out, all right? And hopefully it's something that is very simple, but very clear. There's no ambiguity. Remember what I was saying. It has to, for a bearish one, it has to press to a new high, but close beneath the low of the previous candle. And for a bearish, okay, after a bearish trend, you need a bullish key reversal. Price pushes to a new low, but it has to close above the high of the previous candle. If it does that, you have a key reversal. The trade is on, ladies and gentlemen. So at the end of this session, you will get probably a very quick feedback form. I'd really appreciate if you could just take the moments to fill that in, just give us some feedback when that comes through, because it all helps. And as always, I wish you the best of success in your own trading, ladies and gentlemen. And I look forward to seeing you at the next session for Paul's Ultimate Price Action Trading Guide. Trade well, everybody. Cheers.